Greetings and salutations. Today we're going to look at the company Robert Half, headquartered in the United States and traded on the New York Stock Exchange under the ticker RHI. Please stay tuned for the important disclosure information at the conclusion of this video. Robert Half is an international human resource consulting firm providing services across key sectors including finance and accounting, technology, legal, creative, and administrative. Their core offerings encompass temporary staffing, notably featuring a unique program with full-time salaried employees receiving benefits while working on client projects, permanent placement services, and consulting. Operating in 32 countries, Robert Half generates 77% of its revenue from the United States, with an additional 4% coming from Canada, while Europe contributes another 13%. In 2000, Robert Half became the first staffing firm ever added to the S&P 500 index. Revenue compound annual growth rate since 2005 hovers around 4.2%. This specific number was achieved in 2016 and 2021. Faster revenue growth at about 9% year-on-year was observed during the recovery phase post-2008-2009 crisis. The company reached an all-time high revenue in 2022, and since then shed 20%. Also, the company revenue is 21% below the long-term compound growth of 4.2% since 2005. For comparison, during the 2008 to 2009 economic downturn, the revenue dropped 35%. Overall, the revenue comes from three sources. Short-term contract talent deployment historically contributed 80% of the revenue. However, this share dwindled to 60% after 2020. The revenue mostly transitioned to consulting services, whose share rose from a historic 12% to the current average of 32%. Permanent placements continue to contribute around 8% of the total revenue. Between 2023 and 2024, the operating margin of short-term contract talent deployment dropped to 2008 levels of about 4% from historic 9%. Consulting operating margin, on the other hand, continues to be high at a historic average of 8%. It dropped dramatically during the 2008 crisis but remained elevated during the year 2020. The long-term average margin of cash flow from operations is about 8.5%. It drops to about 7% during the downturn and recovers to 10% at the peak of the economic cycle. To calculate real free cash flow, we will need to subtract capex and stock-based compensation from cash flow from operations. Since 2005, dividends amounted to 36% of real free cash flow. Real stock repurchases, that is, net of stock-based compensation, accounted for 62% of real free cash flow. The remaining 2% was used to strengthen the balance sheet, which is masterfully used during the downturns, to sustain dividends and stock repurchases, and, consequently, being replenished during the economically prosperous times. Free cash flow allocated to dividends grew at an 8.3% compound annual growth rate since 2005. However, the payout ratio of dividends to real free cash flow increased from 23 to 34%. Given the revenue growth at only 4.2%, the current payout ratio would have been higher if stock repurchases showed a significant growth. Even though the share count was repurchased at a 2.7% per year, the absolute amount of cash allocated to stock repurchases, that is, net of stock-based compensation, in 2024 was almost identical to 2005 levels, at about $200 million. CEO Waddell has been leading Robert Half since 2004 and owns 1.4% of the company. That is $62 million at the current valuation and about $170 million at 2022 stock prices. The total compensation amounts to about $7 million per year. Overall, individual insiders own 3% of the company, while 97% belongs to institutional investors. Robert Half has no debt, and a liquidation value is estimated at about $3 million, or about 3 cents per share. Now let's estimate the intrinsic value of the business, using a scenario-based discounted dividends model, based on 6 scenarios. Common assumptions will include: starting in 2026, the margin of cash flow from operations will linearly recover from current 7% to 8.5% over 7 years, the same as it did in 2008. Capex and stock-based compensation will remain at long-term average levels, increased by inflation, assumed to be 2.6%. Free cash flow, allocated to the category Other, will balance out to zero, i.e. some funds will be borrowed from the balance sheet and repaid shortly after. Scenarios 1A and 1B will assume a drop in revenue of 35% from an all-time high of 2022, just like in 2008. That is, a drop of an additional 19% in 2025. After, again similar to 2008, a gradual recovery of revenue at 9% per year over 10 years to reach long-term compound annual growth of 4.2% since 2005 that will be continued after. In Scenario 1A, capital allocated to dividends will continue to grow at 5% per year, with the remainder spent on stock repurchases. In Scenario 2B, all of the available free cash flow will be channeled to dividends. Scenarios 2A and 2B will also assume a 35% drop in revenue, but a long-term growth target of 3%, hence the recovery of only 5 years. Scenario 2A will see cash spent on dividend to grow at 3.5%. Scenarios 3A and 3B will assume the same 35% drop in revenue from all-time high. However, an additional 25% drop in revenue will happen in 2026. The company will recover to only the long-term growth of revenue at inflation levels of 2.6%, which will be continued after. We will briefly look at each scenario, and then summarize the findings in a table. In Scenario 1A, a 4.2% long-term compound annual growth rate, we will be able to collect about $22.39 worth of value per share by 2034, $44.76 by 2044, $68.29 by 2054, and $117.79 by 2074. Allocating all available real free cash flow to dividends, Scenario 1B yields similar numbers of 30.59, 63.08, 86.35, and $114.75. If long-term revenue growth is at 3%, we will be able to collect $73.68 worth of discounted dividends by the year 2074. Similar number of $77.98 for a scenario of all free cash flow allocated to dividends. The catastrophic scenario of a 19% revenue drop in 2025 and an additional 25% drop in 2026, with the recovery to long-term growth at inflation levels, yields $53.75 by 2074. And the number goes a bit higher to $58.22 for the dividends-only scenario. We looked at 6 different scenarios to estimate the intrinsic value per share. We used the discounted dividend model for different final years, 2034, 44, 54, and 74. The share prices of Robert Half appear to be rather volatile throughout recent history. Current valuation predicts catastrophic scenarios, 3A and 3B, with the subsequent collapse of the business model with the revenue growth at merely inflation levels. However, just 3 years ago, the price was almost 3 times higher, corresponding to a business-as-usual situation, with long-term growth of revenue of 4.2%, scenarios 1A and 1B. Half a year ago, the price was almost double the current level, corresponding to a damaged long-term revenue growth of 3%, scenarios 2A and 2B. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur, due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.